Hello, Deep Value community. Thank you for watching. I hope this content resonates with you, and if it does, please subscribe so we can go on our value investing journey together. The topic of today's video is value investing versus growth. So, there are two camps for investors. Value investors, again, trying to seek out the cheapest businesses. Growth investors are trying to buy the best companies. So I'm going to go through the advantages and disadvantages of growth investing and the advantages and disadvantages of value investing. Warren Buffett popularized value investing. Today, he's talked about as a growth investor. He's talked about as a buy and hold forever investor. But when he was doing his partnership in the period of 1956-1969, he was compounding at 30% a year. Subsequently, he has been compounding in the Berkshire vehicle at 20%. This may not seem like a large difference, but if you're compounding at 30% and 20%, it's a huge difference. At 20%, it means just in 5 years, you're going to do 2.5 times his money. More accurately, this is a 249% return over 5 years. Over those same 5 years, as at 30%, you're pretty much on your way to tripling your capital. More accurately, he will have made 371% over 5 years. So moving on. During the bull market of 2017 to 2019, many investors were saying value investing is dead. And what we saw is that as the global recession hit, many businesses got their valuations cut. So we were being led to believe that secular growth opportunity had beaten the economic cycle through their high recurring revenues. So by having a subscription business model, that businesses had done away with the economic cycle. We will see if this is actually the case when we come out of this global recession, but as we see so far, it doesn't seem to be so. So the advantages of growth investing is that you get to buy into the best management with the best growth opportunity. Companies that have strong competitive advantages. These are businesses that are often monopolies or duopolies, what Buffett calls moats. The disadvantage of growth is that you're paying a significant premium for that asset. If the business is indeed a high quality business, more often than not, it will be recognized as being such. So the question is it priced for perfection? Are investors' expectations so high that even having one rough quarter guidance, the stock utterly tanks? So very often these high-flying businesses can get 40% of their valuations cut over a 90-day period. And the news flow over that 90-day period can be very challenging to hear as a growth investor about your own company. It'll be negative, there'll be a lot of doubt put into you as the investor, and the sentiment, the multiple that investors were previously paying will compress, and it will take a while for that multiple to expand once again. Now, the advantage of value investing is that you're buying a company that is really, really cheap. Typically, this business will pay for itself over the next 6 or 7 years. What this means is that if the business has no real growth over the next 6 or 7 years, or you're buying it on a PE of 6 or 7, after 7 years, everything after that is profit. So even if the business just ticks along for 6 or 7 years, it will have paid for itself. Now, the game for a value investor is to try and figure out where the market is slightly wrong. And sometimes you get a bit lucky and the business turns around and you're actually able to make your return, your full return in 2 to 3 years. So you can make your whole 100% return in 2 to 3 years. So another advantage of that is that as the company is healthier, it's able to attract better quality management, and business and investors will be willing to pay a higher multiple for that turnaround business. So you get a business that's increasing its intrinsic value, and investors end up paying a higher multiple for it. So it works out quite favorably. The disadvantage of value investing is that you're buying a business that is often quite cyclical. It's often a rubbish business. It will have along the way one or two positive quarters, but the overall trend of the business is negative. So you get a not so great business. The underlying dynamics of the business keeps falling. So the intrinsic value of that business keeps falling, and the multiple that investors are willing to pay also compresses. So you can think of examples like Blockbuster, you can think of retailers, you can think of outdated search algorithms. So these are the advantages and disadvantages of value investing. Now, what does Charlie Munger say about this? Charlie Munger is a great pillar, a great mentor for value investors. He says that any investing is value investing. What he's saying is that you as the investor are buying a company now and you are getting in the future your return back. So this is something that is up for discussion, and I'll be happy to participate in the discussion. And as always, please subscribe my channel so you can get my next video installment, and together we can go on our value investing journey. Many thanks.